Hello and welcome to a fresh new edition of Value Investing Decoded. We are starting this series this year with someone who's really a veteran as far as markets go. And I'm not talking about Indian markets, I'm talking about markets around the world. He's seen cycles over a period of 30 years, not just here in India, but again, global markets. Madhav Dhar is the man in front of me. Madhav, thank you very much for your time. Great to have you with us.
Pleasure. Thanks, Prashant.
You know, for our viewers, I'd like you to begin by asking you to describe a little bit about your history. Where have you been at? What have you done? And, just a bit of history in about a minute or so, and then we can pick it up from there.
I guess from an investment perspective, I grew up in Delhi and went to school and college here, went to business school in America. After that, desperately searched for a job for a year. Nobody hired me. Talked myself into a job at Morgan Stanley. Started in the investing business, which barely existed at that time, because in those days it was either corporate finance and M&A or sales and trading. So the investing business, which has been the most evolved, in some ways the most attractive part of this whole world over the last 20 years, was non-existent. So it was a sleepy old place with middle-aged guys.
And you shook things up.
Well, it ended up that way, and I was sort of the only young person who was sort of running around in that area. And I guess what happened to me was to compete, or forget to compete, to be able to engage with people twice my age who were talking about what happened in the previous cycle and so on, which was sort of ancient Greek to you. I had to recreate my own history. So I ended up, the best thing that happened to me, frankly, in hindsight, was to make up for my lack of experience and age, I created my own experience and age, which means I just literally sat down and downloaded, went to libraries and got price, value, and economic data of every country in the world and stared at it, made charts out of it, ran correlations and regressions, and just tried to understand it to get up to speed what other people already seemed to know. So that's what got me going and addicted. And then my background and interest was always in physics and understanding how the world works. I thought I would actually be an academic. So I was very lucky that I found both a profession that was as close to science and physics, which is how the world really works from a economic and financial standpoint. And I was also very lucky in a mentor that I found somebody who would take a chance on a young, slightly crazy kid in the mid-90s.
And you rose to head the Morgan Stanley emerging markets business, essentially, right? I mean, you were...
Yes, well, it's actually even more interesting than that. Emerging markets was not even a phrase. So I helped build it. So it was, frankly, all these markets were closed markets, so there was no emerging markets business. In fact, emerging markets, I mean, I was lucky enough to be at a breakfast meeting. There were 5 of us in Washington, D.C. in 1983, and 84, I guess. And we were thinking how to promote investing in third world countries, in LDCs, in Asian NICs. There was no, and Antoine Van Achtermel of the IFC said, how about emerging markets? Because we were discussing how do you get people to say LDC or third world or third rate countries.
No, you won't get any money.
There was no zip to it. So he said, how about emerging markets? And honestly, we all stopped eating. We said, that's it. And that was the creation of the phrase.
Emerging markets.
So emerging markets business came on much later. And yeah, I helped open up some countries, and we did the first funds for India, for Malaysia, for even Pakistan, Africa, Turkey, Thailand. So there were one-off things when you're helping open markets up. So 5-6 years later, you could look back and say, well, they have some standard traits. These are poorer countries trying to develop where markets access has been limited or unknown. So that was the broad definition of emerging markets.
So you actually, I mean, even for a market like India, for our viewers, you were one of the first foreign investors into the country in a way.
Well, I have to say, we were the first foreign investor. In 1989, we did with the SBI CAPS, which was just formed, we did the first fund called the India Magnum Fund, where we had to convince the government to open up markets to foreign investment capital. And so that was ground zero many years ago.
You call yourself a value contrarian? Can I call you a macro value contrarian? Can you explain what that means?
I am now so old and battle scarred that I don't know whether labels mean anything. But I think you are a student of the investing business, and everybody has their own predisposition. And so, yes, so my personality is a value or a contrarian personality. And I've learned the hard way that there are many different ways to win. You know, momentum investors win, short-term traders win. Warren Buffett is, of course, won by sort of being a value contrarian. So yeah, my bias is to look at things that are, I think, objectively undervalued, overlooked, which means sentiment is negative, most people don't like it, where I can detect a marginal positive change that people don't see as a marginal positive change. So my approach is in a way threefold, which is very simply put, I like to buy cheap things that are starting to improve and most people don't agree they're starting to improve. So it's value, marginal change, and negative sentiment. And I like to sell things that are overvalued, where everybody's very enthusiastic, and the marginal change is negative. So yeah, I would, in fact, those are the three axes of how I look at it, which is value, growth, and sentiment. In fact, the macro hedge fund I ran in New York was called Traxxas, and that's a distortion of three axes.
Okay.
And the three axes are value, growth, and sentiment.
Okay, fair enough. You know, a lot of old timers that I've spoken would say that you make money in markets, big money, you make wealth essentially in bursts, in short periods, in a couple of years when there's a big bull market and then the market does nothing for a while and you make average returns. So for you who've seen market cycles and you can see and determine whether there's value in a market or the market is exuberant. I remember speaking to you in late 2013 when the market had sold off, the rupee had hit 68, everything was crashing. And you actually wrote an article in a newspaper, and you came on the show on NDTV as well, and you said, this is actually a great time to buy. How did you determine that? Because, I mean, I think it'll be very useful for our viewers to sort of understand what are the parameters you look at to call, you know, exuberant market which won't go any higher or a bottom.
Well, quick couple of things. Firstly, I could disagree more with the fact that you make money in bursts and then you go away. If you made money in bursts, you may not know when to be there. So most people who accumulate great wealth through investing in an asset class are always there. They may do more at the right time, sort of what...
That's what I meant. I'm not saying they withdraw.
Yeah,
but
my point is you can't trade these things.
Sure,
no average
absolutely.
guy can or should try and trade these things. As they say, you have to be in it to win it. And you just have to know. The mistake people tend to make is get very optimistic when prices are high and therefore vulnerable, and they get very scared when prices are low and the data is bad. That's the classic mistake. You have to avoid those two at a minimum, and at best try and reverse it, which is wade in when everybody else is getting scared, and withdraw maybe a little bit when things get a little frothy. So going back to 2013, the summer of 2013, things were really falling apart. I mean, I think the world in itself wasn't doing very well, and India in particular. I mean, there was this complete logjam and political malaise and so on. Inflation was sticky, growth wasn't there. So, you know, it was just a confluence of several negative sentiments. Markets had already come down a lot. There was this taper tantrum, I guess, in 2013, where all emerging market currencies panicked, including India. So yeah, for me, I mean, I'm structurally, fundamentally bullish on India, and only 10% of it is because I'm an Indian. I think 90% is because this is going to be the fastest growing developing country in the world. And so I'm very optimistic about that. So with that as background, I think the trend growth in India is 6 to 7%. And every time it goes below trend, PEs go below trend, you actively want to buy. So 2013 was no different. That there was an opportunity where people were second-guessing all emerging markets and second-guessing India in particular and its ability to get things done. And so I still believe the trend, when prices go below trend, that's a great time to buy because you're going to grow beyond trend. The market will appreciate above trend if you're buying below trend. I mean, it's simple enough to think of it. It's hard to do psychologically. As the great Warren Buffett life, you know, investing is simple, but it doesn't mean it's easy. So buying below trend is simple, it's just not easy. So for me, it was no different than that. And I also, perhaps more than I should, have great faith in the self-correcting tendency of India. And I don't think it's talked about enough. And people think of in America as a great self-correcting mechanism, and which it is. I think India is the best self-correcting mechanism there is. And historically, the Indian electorate has always pushed things sort of in the right direction. And I think that has happened again. And if the current administration flounders and falters as it is, I think there'll be a price to pay. So I have great faith that the trend growth in India, which over the last 35 years has been 6.2% annual GDP growth, will stay there or will improve. Whether 7, 8, or 8.5, I don't know. I think, therefore, nominal GDP and therefore earnings will be better than they have been. And they've been pretty good in the past. They'll be even better. Anytime you can buy those returns, you should. If you can particularly buy them at points of stress or points of panic, 2013 summer, fall was a beautiful point of panic. I think we're in the throes of another one now. This is much more global in nature, which is affecting India as well. You always want to buy above trend earnings at below trend prices. So to me, it's actually as simple as that. What is difficult is to see when that happens. And that's more of an art than a science.
So late 2013, once you identified, well, this is it, this is when I should buy. What to buy, was that a relatively easier decision? Or
for me, as a macro guy, that's a relatively easy decision because I'm lazy.
Okay.
And the reason is I buy Nifty and then start thinking about it.
Okay.
So
okay.
I think, and that again is one of the biases, I don't mean to be flippant, but in my experience, and more than my experience in my analysis, the country factor is 60-70% of the game. The sector factor is 20-25% of the game. And the stock-specific factor is 10-15% of the game. The entire world, and God bless them, obsesses on this company versus that. I only buy good stocks. I mean, the classic thing you hear is, just buy great companies, you can't go wrong. I mean, that's utter rubbish. Citibank was a great company 30 years ago. It almost went bankrupt. So it's rubbish. You know why? Because all banks went bankrupt. So the sector factor dominated. So anyway, I don't want to get into analytical.
So you're saying the country factor is number one.
Absolutely.
For our viewers, though, the country factor is India. I mean, there is
if
you buy some ETFs.
They should do no
right,
different.
Right.
So just because they're subjected, if their option is only India, and you think there's a below trend valuation and an opportunity, you should buy an ETF, especially for your average viewer. I mean, you may see that India had a great and bounced back, and you were in the wrong stock, or it was a crooked stock, or it went bankrupt, or it didn't participate. For very stock-specific reasons.
Sure.
So even for your average investor, the thing would be if you really have the courage to step in when everybody else is losing their head. And if you have a fundamentally structural sound view of India, as I do, and you're getting a below trend price opportunity, you should first buy an ETF. Get invested first, far more important. Then if you think you know better, you have better analysis, you want to take a shot at it, either all of it or some of that ETF investment can be slowly sold and bought into stocks you want.
That's second stage.
That's second
But okay,
stage.
fair enough. So country, then sector.
Yeah.
What attracts you to sectors? I mean, what are the things that you look at, which makes?
Well, again, I don't get wedded to certain things. So I think there's a season for everything.
Okay.
So some people certainly, I'm a tech guy, or I only like these multinationals or pharmaceuticals. I don't believe that. I just think there's a cycle, there's a season for everything.
Okay.
And so it depends. It depends what kind of cycle we are, because what kind of. I mean, I never thought that I would get there, but for the first time I think in 10 years, I'm starting to look at commodities. I'm starting to look at deeply cyclical sectors. And I never thought, if you'd asked me that 2-3 years ago, I said, I don't even think about it. I only think about it from a short side, because I've had such a negative view on commodities and growth decelerating that you don't want to be that. This price adjustment is happening very fast. So to me, it is opportunistic, and it's not opportunistic in a weekly trade or a monthly trade. It's a multi-year opportunistic. I think we are getting slowly set up to take, again, to use your starting words, a value contrarian approach to sectors and to countries. So I think, oil, aluminum, all these things, I'm not there yet, are getting very interesting. Brazil is getting interesting. Russia is getting interesting. They're getting really cheap. They're getting sold off. Everybody has completely lost faith in emerging markets, and within that, those emerging markets. Why? Because they're China-centric. They're commodity-centric. Yesterday's story. So I like that. I like blood, revulsion, disgust, unsexy stories. I love stuff like that. I'm a boring old man. So I am starting to get invested. So there's a season for everything. So it depends.
Can Indian investors, retail investors, buy funds exposed to other countries, for example, Brazil, Russia? I mean, is there a way to do it?
I think you can. I mean, you probably know this better than I. I mean, I've been discussing it. I think up to a certain amount of money, they can buy these things. I don't forget exactly what the limits are, but yes, you can broaden your portfolio.
So from your perspective, one important thing to remember is also the fact that the world never ends. I think one should remember that, right? I think it's a useful lesson.
Listen, that's certainly been both my experience and my predisposition and my education. So, I mean, I remember one of the most classic times was March 2009, and the S&P was 666, which is the devil's number, and I was at a party of the rich and famous of the hedge fund crowd at a very well-known person's house. There were 50 world-class investors, and 40 thought the world was going to end.
Okay.
These were not your laymen. These were professional investors that proved to me that the American balance sheet is actually negative, and therefore equity prices should be zero. So I've seen that, and you're staring at the abyss, but the world never ends.
Okay.
Somehow it finds a way to bounce and regrow and reform and adapt and heal itself. So that is, as I said, both my learning and my natural DNA. So you use that to your advantage. And to be intellectually honest, it has ended every now and then. If you sold Japan on New Year's Day in 1989, it's gone down for 27 years. Straight down for 27 years. World ended. So there is no value contrarian in Japan. There's no momentum investor in Japan. So a 45-year-old professional Japanese investor thinks that stocks go straight down. And he's justified in believing that. A 45-year-old American investor thinks the stocks only go up. Justified.
That's what the stocks have done in his lifetime.
Yeah. So the world ended if you were an investor in German industrial shares in the 1930s, the world ended. In 1942, it all went to zero. We went bankrupt. In Japan, the same way then, and same way again in 1989. Other than that, the world never ends. So, I mean, just look at our own country. Look at India. Look at what we've been through. We've been through terrible coalition situations. We've been through massacres. We've been through bomb threats. We've been through terrible socialist policies. We've been through bank nationalizations. We've been through false promises. We've been through absurd pricing, and the GDP is up 6% plus for 35 years. Stocks are the third best performing market in the world in US dollars. You just have to stare at it and you say, wow, that's amazing.